Thank you for watching this video. We're going to talk about how to maximize your retirement income by changing how you manage your thrift savings account. While government employees and military members are normally given details by their personnel department about eligibility and benefits of their TSP, they rarely receive credible advice on how to choose the options that will maximize their retirement income. With an executive MBA degree and over 20 years' experience analyzing market trends, I discovered a better approach to increasing my retirement wealth before and during retirement. In fact, my analysis of market trends contradicts the conservative and conventional advice repeated by professionals across the financial industry. As an analyst, I make data-driven decisions. I don't make financial decisions emotionally. You'll see some of the data I've used to guide my own decisions and recommendations. If you understand how to assess your personal investment risk, you can leverage that knowledge to maximize your retirement income. In this video, I'll show you how to assess your personal financial risk and show you how to make choices that will maximize your TSP investment before and during retirement. For your reference, the tax laws governing contributions to and withdrawals from all types of IRAs are in IRS Pub 590A and 590B. So, what do I know that they don't? Benefit counselors, financial advisors and planners, and insurance agents have not retired yet, so they lack personal experience with the outcomes of their own advice. I have lived the entire spectrum of investing before and during retirement, withdrawals after retirement, and I am currently receiving my RMDs. I have maintained market data and detailed documentation of my finances for over 30 years. I know the financial consequences of the choices I made. You do not need an MBA or a business finance degree to understand the risk concepts or the investment strategy. My name is David Vail, and let's get started. Let's start with some basics. The TSP offers choices of these 5 funds. The stock index funds, the C, S, and I, track an index of very large U.S. company stocks on the Dow, like the S&P 500, an index of medium to smaller company stocks, like a U.S. completion of the total stock market, and an index of stocks of international companies, like Morgan Stanley's composite index for all countries except USA and China. The F Fund tracks Bloomberg's aggregate bond index, which tracks U.S. government and corporate bonds, which pay a specified amount of interest if the bonds are held to maturity. Lastly, the G Fund tracks U.S. Treasuries, or T-bills, which are not subject to market changes, and routinely pay interest rates similar to CDs at your local bank. The standard conventional advice recommends a mix of these funds for diversification and safety. However, the issue I have with those recommendations is they are treating an index fund as having the same risk as individual stocks. If you have the C Fund, which tracks the S&P 500 index, you are diversified because the index is invested in the largest 500 companies listed on the Dow Jones Exchange. If a company in the S&P 500 index goes bankrupt or merges with another company, the next one, number 501, in the index moves up 1 spot to maintain the 500. The S Fund tracks a medium to smaller cap index, which tracks over 4,500 companies on the Dow that are below the S&P 500. If you have the S Fund, the index is invested in those 4,500 companies. In my opinion, further diversification only dilutes the benefit of an already diverse account and is not financially rational. Let's talk about those L funds in the TSP. A life cycle, or L fund, is commonly known in the financial sectors as a target date fund. If you select an L fund for your TSP allocations, the TSP actively and automatically manages your account by frequently rebalancing your allocations to maintain their recommended target percentages for your mix of assets based on your age and proximity to retirement. Let's look at how the TSP automatically rebalances your allocations over time. With L funds or target date funds, you would select a fund aligned with your current age, which correlates to a proximity to a target retirement age. This chart comes directly from the TSP publication cited. You do not get to select the funds that are components of the L funds. The TSP does that for you. As you age, the percentage of each component allocated in the fund is automatically and continuously adjusted to achieve the intended target allocation of your account as shown. The long-term investment strategy is growth in stock funds while you are younger, and then when you reach 40, they begin the transition to what is called preservation of assets for income in retirement. According to the TSP, you would have 99% of your account in the C, S, and I funds until you reach age 40. And by age 65, 25 years later, you would have 74% in the G and F fund and only 26% in the stock index funds. It might sound good. Your entire investment is on autopilot. However, look at the bottom banner in yellow. This always means reducing your allocation in higher performing stock funds and increasing your holdings of lower performing bonds and treasuries starting decades before you will retire. This strategy isn't actually good for you because this methodology results in lower income during retirement and depletion of your retirement funds while you still need them. On the next slide, we will show you how Vanguard handles target date funds. While their target allocation numbers are different from the TSP, you'll see the concepts are the same as the TSP. As I said, commercial financial companies offer target date funds with differing target percentages for the mix of funds for each age. This chart comes directly from Vanguard's website. Like the TSP L funds, you do not get to select the actual funds that are components of the target date funds. And as you age, the percentage of each component allocated in the funds is automatically and continuously adjusted to achieve the intended target allocation. By stating they are fiduciaries, they convince you this is what's best for you. Just like the TSP, the long-term investment strategy is growth in stock funds while you are younger, and then, when you reach 40, they begin the transition. Comparing TSP to Vanguard, by age 65, 25 years later, you would still have 50% in stock funds, where the TSP would only have 26%. Notice the huge difference in bond treasuries mix. Vanguard is 42% bonds and 8% treasuries at age 65, while the TSP is flipped, with only 6% bonds and 68% in treasuries. I promised to talk about how to determine your personal financial risk. So let's move on to that. I believe the conventional risk statements are grossly exaggerated. As you saw in the previous slides, the recommended mix for portfolio assets with frequent rebalancing assumes everyone the same age has the same risk, which we know intuitively is false. It also assumes a TSP will be a primary or only source of income which cannot withstand any market downturn resulting in reduced income during retirement. Those broad assumptions are not supported by the IRS income data on seniors or historic market performance data. We're going to look at both. According to the IRS, typical TSP participants have multiple income streams during retirement, either by themselves or in combination with a spouse or partner. Shown below are just some examples of normal income streams that retirees have. Personal financial risk must be evaluated in the context of a retiree's total income and must factor in the resilience of the stock market. So, how do you determine your financial risk? Let's separate risk before retirement from risk after retirement. They look a lot alike, especially normal living cash flows and debts like mortgages and car payments. But there are some important nuances. On the left, before retirement, income comes primarily from paid employment, from wages, salary, or self-employment. Everyone has to manage their own cash flows and debts. While discretionary, payroll contributions to your retirement account are a discretionary expense that reduces spendable income. Because of dollar cost averaging, a bear market before retirement offers the opportunity to acquire more shares at a lower price, hence the catchphrase, buy the down or buy the dip. During retirement, income from pensions and Social Security is fixed with annual cost of living adjustments. Annuities are typically fixed for the length of the contract. The amount of income you get from a traditional IRA, 401k, or TSP during retirement is discretionary until you reach the beginning date for required minimum distributions, or RMDs. A bear market during retirement has no effect on pensions, Social Security, or annuities. Since the annual RMD is calculated using the balance each December 31st, each annual RMD could go up or down. At age 75, the annual RMD is 4% of the TSP balance on the prior December 31st. Both before and after risk scenarios require you to have an understanding of how much monthly income you might need to support your standard of living, whatever that standard is. We'll use the next slide to determine how to calculate your risk number. Here's an example of how to get a ballpark estimate of your personal financial risk. Start by listing each retirement income source in both monthly and annual amounts to derive an estimated monthly and annual total gross retirement income. Beside each income source, calculate the percentage each income source represents of your total gross retirement income. The percent total column should add up to 100%. In this example, for a married couple, both over 65, distributions from their IRA, 401k, or TSP are $2,500 a month, or $30,000 annually, and make up 19.9% of their total retirement income. I used a model tax estimator to give me a ballpark estimate of their federal tax and net income for 2026. On the right, you see an assortment of normal, mandatory, and discretionary expenses experienced by everyone, whether working or retired. If you track your own spending, it will be easy to see how much you need annually to support your standard of living, and easy to compare that with your projected net income. The question to ask yourself at this point is this: how much of the TSP annual income stream would you need to be able to cover your listed expenses? If you can cover them all with the other income streams, then your TSP investment risk is zero. If you need half of your TSP income to cover those mandatory expenses, your risk number is 19.9 times 0.5, which is 9.95. The lower the calculated risk number, the lower your financial risk. Cuts in any of the discretionary expense categories also reduces your calculated risk number. The point of this exercise is to determine your financial risk using critical thinking and an analytical method instead of emotions and guesses. I promised at the beginning to keep this at a high level, but I also promise to show you the data I use to make my own choices. This table shows the market performance of the various indices over the past 25 years. I started collecting this data in 2005 after hearing Warren Buffett tell a reporter that working people shouldn't try to beat the market and simply put their money into an S&P 500 index fund and leave it there. I implemented his advice in my own retirement account, but I wanted to know what kind of story the data told. So, I started by gathering the annual performances for those indices for the previous 10 years, back to 1994. In January of each year, after 2005, I added a row with the previous year's results. By 2015, I had 20 years of data to look at from a high level, and the long-term market trends were recognizable. The red loss years for 2000, 2001, and 2002 were known as the dot-com bubble burst. Well, there wasn't room here to show the 5 prior years from 94 to 99. In 1998, the NASDAQ 100 gained 85%, and in 1999, it gained 104%. No wonder the tech bubble burst. No company can sustain that kind of growth in value. But this proved to be an anomaly when viewing it through a long-term lens. Let me ask you a rhetorical question. If we were at a casino and I told you that I observed one slot machine that paid 5 or 6 times in a row, then on the 6th or 7th coin it did not, and then repeated that pattern over time, would you keep playing that slot machine knowing you would lose the 6th bet after winning 5 in a row? That's similar to what I discovered while analyzing market data over decades. If you ignore the dot-com bubble burst and focus your eyes on the 4 highlighted indices from 2003 to present, you can see the Dow Jones and NASDAQ indices only experienced 3 losses: 2008, 2018, and 2022, with only 2008 and 22 significant. After each loss year, there is a string of years with gains. For my investment decisions, the observable patterns in long-term performance listed on the left side of the slide were predictable enough for me to declare the conventional risk statements to be grossly exaggerated. The performance summary on the next slide uses the data from this table to make it easier to see and understand. Without needing to remember all the details in the previous table, I simply calculated the 5-year, 10-year, and 20-year averages for all indices in the table. It's important to remember the 5-year average includes the big loss years in both Dow Jones and NASDAQ in 2022. The 10-year average includes the losses in 2022 and 2018. And the 20-year averages include all 3 loss years going back to 2008. It's easy to see by looking at the results for 2025 alone. A person might be convinced to invest in an international fund index which gained 32% last year. But that seems to be an anomaly given the long-term performance numbers for 5, 10, or 20 years. While looking at this slide, I had a couple last week ask me what I considered to be long-term. I told them that looking at this summary, 5 years was sufficiently long enough for me to make a buy and hold investment decision. Notice the CPI-U inflation numbers on the right. I added that from the Bureau of Labor Statistics as a benchmark to help gauge the relative performance of bonds and T-bills as a hedge against inflation. I concluded there was no benefit to be had by including either bonds or Treasury securities in my portfolio, ever. I know this contradicts what every financial advisor, financial planner, and insurance agent tells you, but these numbers and the table in the previous slide are facts, not opinions. Looking at the last slide in this one, Where would you want your retirement account investment? This is a no-brainer to me. Using annual return data from the annual performance table, I wanted to see the cumulative impact and value of investing $100 in each of those indices 20 years ago. To be clear, this shows the change in market value for the original $100 without additional funds injected or invested. You can readily see the three loss years in 2008, 2018, and 2022. But the loss in absolute dollars is greatest in 2022 when the Nasdaq lost 33% and the S&P 500 lost 18%. Unfortunately, the top performers, the Nasdaq funds, are not available to government civilians or military members through the TSP. What this chart loudly emphasizes is the consistency of market rebounds immediately following any downturn. It also is really easy to see what would have happened to your invested retirement savings if you selected an L fund, which continuously rebalanced your portfolio to decrease stock funds and increase bonds because of your so-called age-based risk. Now that we've examined market performance and trends over the long term, which verified Warren Buffett's advice, I'm going to show you the impact of that performance to my own retirement account after I followed Warren Buffett's advice. I can't remember precisely when in 2005 I implemented Warren Buffett's advice, but I do remember I didn't have a lot of money in my government thrift savings plan account, and original allocations were fairly equally split between the S&P 500, a small cap index fund, and an international index fund. I was contributing 15% of my pay to my thrift savings plan and was getting a 5% match from the U.S. government until my eventual retirement in February of 2016. The U.S. government does not offer NASDAQ funds to its civilian employees or military personnel. My TSP account was fully allocated to the S&P 500 fund from 2005 and remained in that fund until last year. The red line at the bottom is the cumulative amount of my payroll contributions up until my retirement date in February of 2016 when contributions stopped. Notice the relative market value of my retirement account at that time indicated where the blue line intersects the first dotted line. That's when I started taking monthly distributions, initially using the standard 4% rule to establish a fixed monthly installment until my RMD beginning date. Notice the change in market value between the dotted lines while taking monthly distributions and keeping my allocation in the S&P 500 index fund. Do you remember the big loss in all equity funds in 2022? The big decline in market value of my account was caused by the combination of the market loss and the onset of RMDs at the same time. But notice what happened after that big dip. The remaining shares rebounded immediately and have continued to increase in value faster than my required distributions. Anyone who invested at the same rate following the same advice from Warren Buffett would have a chart that looks identical to this. You don't need the absolute dollar values to understand the results of the financial decision. In April of 2025, I established a rollover IRA with my broker and then rolled my entire TSP balance into that new account so that I could take advantage of the impact of artificial intelligence on the NASDAQ 100 index. You can see what happened when I made that move. Looking back, if I had listened to the conventional advice, my retirement funds would have begun declining when I began taking distributions starting in March of 2016. It's been 10 years since I retired, and I wonder what this chart would have looked like. It should seem obvious that increasing your wealth before retirement will increase your income during retirement. It should also be apparent that you do not need to replace stock funds with bonds and treasuries as you get closer to your planned retirement, because your personal financial risk is not based on your age or proximity to retirement. So here are my recommendations. Before retirement, you have already seen that the Large Cap C Fund has the best long-term returns. So avoid bonds and international funds. Stay away from those target date L funds because the constant automatic rebalancing severely reduces growth needed to support you during retirement. I encourage people to only use the G Fund as a temporary holding spot while transferring funds. After retirement, I strongly recommend doing a direct transfer of your entire TSP account into a brokerage rollover IRA so that you have access to the entire investment market. Once transferred, allocate your IRA balance to funds that track the NASDAQ and S&P 500 indices. Finally, learn to manage your own retirement account because your quality of life in retirement depends on it. It's not hard. In long-term investing, occasional down years are part of the price of participation in the investment markets, but they are just noise to be ignored. Thank you for watching. I realize my market observations and subsequent recommendations contradict virtually every professional working in the financial services industry. And you'll have to decide whether the facts I presented support my recommendations. I personally believe that all financial professionals believe in the advice and products that they offer, but I also believe the senior executives in all those companies have to know what I know. I truly believe it's not possible that they don't know, because it's how their companies make money. I wish you all a financially secure retirement.